Hello, Dan.
Hey, James, how's it going, man?
Good, good. All the readers know me as Woody, so you can call me Woody like you normally do. It's all good. Um,
Oh, I didn't mean to be formal.
how's everything going? You're now based in Wyoming, I hear, and you're a pretty new resident. I think it's like maybe your third city in the last 10 years that you've had to settle into.
Gosh, I hadn't thought about it that way, but I guess that's right. I mean, I'd say London was the last place I had a lease, and that was in 2018, end of 2017. So, back when you could still travel the world without proving that you didn't have a virus, I bounced around quite a bit. But the last year prior to earlier this month, I was mostly in Colorado, and then I had planned on coming to Wyoming for a long time for a variety of different reasons. It's only about 100 miles as the crow flies from where I was in my old family home in Colorado.
Mm.
But I'm in Laramie, which is not the state capital, but it's where the university is located, and yeah, it's interesting. It's so far so good, but I've only been here for about 3 weeks.
But just like in Colorado, it gives you, I wouldn't say you're isolated as such, but it's nice and quiet over there. I mean, from what I know of Wyoming, and probably gives you a bit of time to be able to reflect on the what's happening in the world of finance, economics, and in the investment markets without much distraction, I'd imagine.
Yeah, I mean, I think that's right. When I was in Melbourne last, it was in March of 2020, and I had plenty of time to focus on financial markets because I couldn't go out of my apartment, and I was on the 25th floor of a high rise on Collins Street. And here we are 18 months later. So there's still a lot going on in the world, and I can focus on what's going on, but I have a little bit more freedom of movement, which is important to me.
Yeah, 100%. And you're growing a garden, which is going to be well documented. But Dan, so while you've had a bit of time to think, I've had a sneak preview of today, and today is Monday, by the way. We're recording this Monday time. I'm not sure when this is going to be released. So the story that I'm about to ask you about might have developed between now and then. But I want to ask you about the Evergrande situation in China. Now, you wrote about it in Run Rebellion today. But for those that, I mean, there's a bit of reporting on it here in the press, but for those that aren't maybe familiar with it, can you explain why it is such a big deal?
Yeah, well, Woody, I think I'm going to take a little indirect route to it, but I won't go too far afield. But in some ways, it's fully to be expected that at the end of a leveraged boom in any asset class, there's always someone who's caught out as being over leveraged, and there's a moment where that's exposed, and then everyone tries to figure out who's most at risk. So that's where a lot of the discussion is right now in the Western media is, okay, it's the second largest property developer in terms of assets in China, but it has dollar denominated bonds that are about $600 million worth. Who owns those bonds? Is the company going to default? Who's on the hook for that? Will the government intervene? So that's all fairly, it reminds people of what happened with Lehman Brothers. But Lehman Brothers was a systemic crisis because there was general rot in the types of assets that Lehman Brothers owned, which were mortgage-backed securities. So the question is, well, is this the tip of the iceberg in China in terms of the real estate developer market? And that's important to Australia because real estate development not only is a huge driver of house prices in China and China's GDP and all the other industries that are associated with the housing market, but it's also a huge consumer of raw materials and commodities, many of which come from Australia. So it directly affects the demand for iron ore and copper and aluminum, all down the line, and all sorts of industries that are related. So that discussion is going on right now, but I would say a lot of that is already baked in the cake. A lot of the reaction has already happened. To me, the interesting discussion, if you want to go into it, is what does it say about China as a capital market, and how is that a sneak preview of what may be going on in our own markets? And I think those are two very important subjects to follow up on.
Do you think it is the 2021 version of Fannie Mae and Freddie Mac? That they are too big to fail? Do you think that's where the risk is, or or not? You're shaking your head there.
No, I don't think so, because this is not a market failure. This isn't something that's happening spontaneously. This actually goes back to last year. So let me take you back to over a year ago, August of 2020, maybe October of 2020. Jack Ma, who's the richest man in China, he's like the Warren Buffett combined with Jeff Bezos. He owns Alibaba, which is the Amazon.com of China. It's $1 trillion company. So, take your most famous and richest Australian entrepreneurs, Kerry Stokes or Rupert Murdoch or Gina Reinhart. So on the verge of the IPO of Ant, which was his financial technology company, which is going to IPO in New York, Ma gives a speech in China, which is highly critical of state-owned banks and the Chinese financial regulators. Then in November, the IPO of the Ant Group is completely canceled by the government, and Jack Ma basically disappears. So he's been seen a few times. It's amazing to me, actually, that you don't see more coverage about this in the Western press. So imagine if Gina Reinhart was arrested by the Australian Federal Police, or was silenced somehow by the federal government, and no one said anything about it, and no one saw her go anywhere. Imagine if that happened to Jeff Bezos, that one minute he was the richest man in the world, or at least in America, getting ready to go to Mars or whatever he's doing these days, and the next he was gone from public life. So this was the beginning last year of a crackdown by the Chinese Communist Party against high-profile capitalists, which included a lot of the highly leveraged real estate developers. So at that time, the Chinese regulators announced this thing called 3 red lines, which I'm not going to go into a lot of detail, but it put the real estate developers on notice that if they didn't reduce leverage so that home prices would come down, then regulators would come in and they would force them to deleverage. So what I think is happening now is part of that forced deleveraging of the Chinese real estate sector. And I don't really think the Chinese Communist Party would start that process not knowing what the outcome was. So if anyone's going to lose money, it's not going to be Chinese investors. It's probably going to be commodity investors or non-Chinese owners of dollar-denominated bonds. That's probably who's going to end up losing the most money. And there's second order effects as well for commodity producers and people who own shares in those commodity producers. But no, I don't think this is going to trigger a systemic crisis all around the world in the way that Lehman Brothers did.
Okay. So the potential, you touched on a couple of the potential consequences for Australia. And kind of Jim Rickards made the same point last week, actually, when I spoke to him, was that the vast majority of the companies they're cracking down on are predominantly owned by US shareholders. So it's not necessarily going to be Chinese investors that are going to suffer, or the everyday Chinese folk. And we've been writing this for a long time. The ultimate thing is that it's people before profits in China, isn't it? If the Communist Party isn't seen as having control, well, that they're going to move to move against that. But potential consequences for Australia, you said, for example, is the iron ore price collapse linked to this?
I would think so. I mean, you've got guys that follow that on a more regular basis and see where the demand is coming from. But there was an amazing video at the end of August.
The Ghost City.
Yeah, and my colleague here in the States, Tom Dyson, had traveled to China as part of his worldwide tour with his family, and that was one of the questions that came up. Then is from a strategic point of view and the national plan where China's investment is directed by the state, we were always told that this type of investment in residential real estate and in infrastructure would eventually be occupied by people moving from the countryside into the cities, that it was just forward-thinking, state-directed investment. And I think the point I made in Rum Rebellion today was what it is classic misallocation of capital by state planners who are making decisions on behalf of the state. These were not decisions driven by people buying property. So now we know part of the answer, that a lot of that speculation in real estate development was done purely to make money for the developers. And I think that's one reason the government itself wanted to crack down on it, is it doesn't want to impoverish investors or home buyers in China to get caught up in what effectively looks like a real estate Ponzi scheme at some level.
It's pretty insane, isn't it? Looking at that video. I mean, it's because you talk about ghost cities, and we discussed this when I first moved to Australia back in Greg and I did a big report in 2012 on this very issue. It's quite incredible how the misallocation of capital can go on for so long, and it could. It's probably going to go on for a long time to come over there, isn't it?
Yeah, and I think the key difference now is that although there are a lot of state-owned banks that are involved, and there are a lot of Western investors that may be involved with some level of exposure to the bonds that were paying high yields, the biggest threat to the Chinese Communist Party is that Chinese savers and people who are buying houses are involved. And if the party gets blamed because the real estate sector squandered the savings, the lifetime savings of ordinary Chinese people, then that's bad for the party. That's why the party started cracking down on this kind of leverage last year. So in that sense, it shouldn't be a surprise. I think what people need to remember is there's a version of this kind of what you said, people over profits, or what the Communist Party says is common prosperity. We can't be concerned with individual wealth, not even if you're a shareholder, that unless everyone is getting richer as the country grows, then there's something either immoral or evil about it. That has its own version in Western markets now in the form of this ESG mantra with investing, where it's environmental sustainability and governance. These things are so poorly defined, but I would say what they are is that they're collectivist ideas that are inherently subjective being applied to the management of for-profit businesses. So what we're seeing in China is what we're starting to see in the West is the state is telling private businesses, you will run your business according to what we think is important. And in China's case, if you don't, they'll just disappear you, or they'll cancel your IPO, or they'll initiate some regulatory investigation into you, which causes you trouble with your listing in the US or somewhere else. So there's a version of this going on in the United States and in the UK and Australia. It just hasn't reached the overt level where the state comes in and basically kidnaps a trillionaire.
Do you think one of the risks are that it's going to come to that in the West?
Yeah, I would describe it as a sort of a revolution in corporate governance by the back door, that instead of trying to put people on a board who explicitly value whatever stakeholders value, you've seen large asset managers like BlackRock or Vanguard or state pensions run by people in New York and California saying, we're going to start investing billions of dollars or trillions of dollars in assets under management on metrics that are other than return on equity or return on capital or return to shareholders, that there are larger social measures. So when you talk about a company's social responsibility, this is just recycled Marxist language about taking over the private means of production. It's just dressed up as social responsibility. So I think that's a clear and present danger right now in the US and Australia and in the UK especially.
Yeah, right. The latest monthly issue of the Bonner-Denning letter, for most people will know this and our readers, but if you don't know, Dan, you write the Bonner-Denning letter with Bill on a monthly basis. It's published primarily in the US, but we're quite privileged to be able to publish it over here. Thanks to our connections, it's great. But the previous, I know you got an imminent new monthly coming out, and that's what you're busy working on at the moment. But the last one was quite good, and I wanted to just address a couple of the points in that, because the overarching idea is that you're addressing what the potential big loss is in the markets. Now, in the introduction, Bill points out that you can afford to take some risks when you're younger. That's when you have like the most to gain and the least to lose, really. But as you get older and the calculation changes, and a big loss, if a big loss comes along, it's something that you may never recover from. And you point out there's lots of markets that look super overvalued at the moment. The four key things Bill points out from your extensive article is cryptocurrencies, tech stocks, stocks in general, and the bond market. So I thought we could just cover a few of those. I delved into the issue as I always do, and I just pulled out a few things, and I thought we could just expand on them a little bit for our readers and hopefully help our readers figure a few things out for themselves. So I'm sharing my screen. Can you just, you can see my screen, can you, Dan?
Yes.
So the first chart that let's look at stocks in general first of all. You highlighted how stocks generally have never been more expensive relative to the real economy than they are now, and you showed that via this chart, which is the total value of all publicly traded stocks against GDP. Can you explain what that tells you?
Yeah, so this is not my proprietary indicator. I first saw it early in my career, and at that time it was published by a colleague of mine, Dr. Kurt Rischenbacher. But for whatever reason, in subsequent years, it's been popularized as the Buffett indicator, named after the famous investor Warren Buffett. And it's a simple ratio between the total value of goods and services traded in the economy and the market value of all publicly traded companies. And so what does that tell you? Well, it's showing you the value of financial assets relative to the activity in the real economy. And to make it useful as any kind of valuation metric, you have to look back at it through time and over time. And over time, you see that 80% is about the ratio, that the value of publicly traded stocks and all the earnings that they generate is about 80% of the total GDP of the economy, which makes sense. The companies exist within the economy. But as you know, when you're talking about stocks and earnings, it's not what they've done in the past we're talking about, it's what they're going to do in the future. And typically at the end of the economic cycle or the credit cycle, when people are very optimistic about future earnings, or when interest rates are very low, as they have been now for quite some time, then expectations for the future are very high. So the ratio goes high. People pay a lot more for stocks than what the real economy is doing, because they think that the future earnings for these companies are going to be incredible. So what you get is what you got in 2000, where the market cap to GDP ratio went very high, because everyone thought the internet was going to change the world, which it has in some ways, but it didn't materialize into actual earnings for the entire economy. Only a few companies survived.
Just for 4 companies. Which we will come to.
Yeah, no, I mean, there were definitely some big winners, but yeah. I think the important, excuse me, I think the important thing for people to understand when they look at this is that it's not a market timing indicator. It doesn't tell you when to sell. It tells you that the ratio of the stock market to the real economy is out of whack. That can stay that way for a long time depending on liquidity, which is why we spend so much time focused on interest rates and whether they're going up or down. But as long as money is cheap and as long as interest rates are zero, then it tends to funnel money out of fixed income and bonds and into aggressive growth momentum stocks. And that's kind of exactly where you are now, except we're sort of further than we've ever been right now in terms of the ratio between the market cap of the stock market and the economy. So it tells me financial assets are massively overvalued to what's going on in the real economy underneath.
It's pretty crazy when you look at it. I mean, the 2000 tech bubble just looks like a bit of a hill, really. and the massive GFC. I mean, in 2007, it's yeah, like I say, it's pretty stark how expensive stocks are compared to both those times.
Yeah, we've never seen anything like it, and that's because rather than being concentrated in one sector like it was in 2000 with technology, or in one particular area like it was in housing stocks and financial stocks in 2007, because interest rates are so low and real interest rates in many places are negative, then the equity market relative to the economy is as large as it's been in a long time.
Yeah, well, you do finish that section in the issue just by saying you have been warned, and that's all these charts are showing you. The next one I wanted to bring up, Dan, which is kind of the other potential big risk that people need to be wary of, is to do with the bond market. Now, this chart here shows you that high bond yields have never been lower. Now, you write that this also shows you why stocks probably are really overvalued at the moment, but it also reveals the biggest, you said, unintended consequence of the Fed's policy to keep bond yields really low. Can you explain that in relative layman's terms for people, please?
I'll try.
If you can, yeah.
I mean, the best thing they should do is just subscribe to the letter, and they can get it in
Do not worry, I'm going to give them that option.
No, I would say there's two things involved with low interest rates, really three. One is that monetary policy officials, like the governor of the Federal Reserve and the Reserve Bank of Australia, believe that that's an important way for managing the economy. And if economic growth is slow, then lowering interest rates, making the price of money cheaper, is one way to encourage the growth of credit, which has all sorts of multiplier effects and raises economic growth, which raises employment, which raises wages, and everybody's happy. That's the theory. The reality is, one of the reasons that interest rates are so low is that government debt is so high. And we call this historically financial repression. That in order to make it possible for the government to refinance its debt, continue to borrow large sums of money, as it's been doing during the COVID pandemic, then the lower interest rates are, the more affordable it is for the government to run these high debts. The consequence of that is that people on a fixed income and people who save money and used to earn interest off that money are no longer earning interest on that money, whether it's in their savings account or by getting a dividend from stocks. Because as government bond yields go down, it drives the bond yields down on all kinds of debt. And that's why I put it in the chart for high yield debt. Normally, junk bonds, as we call them, or high yield corporate debt, has a higher credit risk, because these are companies that they have to pay the interest on that debt through earnings. And if those earnings don't materialize and they don't have enough cash set aside, they can't pay the interest that they owe to bondholders. So that's why you get a higher interest rate, because you're taking a risk on a company whose business model might not pay off, or who may just fail and maybe run by stupid people, or something changes in the world. So you normally get compensated for that risk with a higher interest rate. But what these indexes of high yield bonds show is that these are non-investment grade corporate bonds whose yields have never been lower, which means you're not, as an investor who wants to loan loan money to these companies, you're not getting paid for that risk. So the risk is mispriced, which means you're probably taking on more risk than the price indicates, and that results in losses quite quickly. Mm-hmm. Normally, the bond market will tell you that you're taking on risk, but the unintended consequence of monetary policy is the mispricing of risk throughout not only the fixed income sector, but through the equity market as well.
So you're basically getting less in return for just the same amount of risk as before, when it was priced a lot higher. It's pretty nuts.
Maybe even more risk, because one of the things we've seen in the COVID pandemic was that, unlike the last global recession in 2008, when corporations reduced their leverage as a result of the financial crisis, because interest rates were so low as we went into the pandemic in 2020, many corporations increased their leverage. So they actually have more debt going into an uncertain period at a time when interest rates are historically low. So not only are you not getting compensated with a high interest rate, but you're getting a corporation that might have more debt than it normally would as you enter a possible recession. So again, it's the signals aren't really conveying what we think the amount of real risk is to investors right now.
Do you think it's kind of ironic that there's this big push now? Obviously, it's like a cyclical thing. There's this big talk about wealth inequality across the world at the moment, and all the money's gone to shareholders while the average Joe is blah, blah, blah. The wealth gap is huge, and we've got to address this. Yet there a lot of the people that are voicing those concerns, they're actually in support of a Fed or a government that's actually causing maybe unintendedly, like you just said, but it's partly what they're doing is causing this huge thing.
You're being fair-minded to the policymakers, because it may have not made the press in Australia, but there was a very small article that came out a couple of weeks ago that showed that during the course of the pandemic, where the monetary authorities, the Federal Reserve, were buying corporate bonds and being very active in supporting the market, both with interest rates and verbally, They were actively trading in and out of S&P futures and individual stocks and some corporate equities. These people are millionaires and had positions over, $1 million apiece in 27 different positions. So I'm not saying that all of them were doing it, but the idea that monetary policymakers are setting interest rates because it's the best thing for the working class or for the economy is stupid. It's quite clear that low interest rates benefit financial asset owners, and the people who run our central banks usually come from private banks and are large financial asset owners. So while they may pay lip service to being guardians of sound money and inflation and full employment, don't tell me they don't have a keen eye on the value of their portfolios, which have done gangbusters during the pandemic, while people on a wage have been told they can't even go to work.
Yeah, it's insane. I didn't find it, but I was just trying to find a tweet that one of our fellow editors, Ryan Dintz, posted. I don't want to say the name in case I got it wrong, but he highlights one of the Fed's chief people that were investing in municipal bonds, the very bonds that the Fed was buying. Yeah, it's so corrupt. It's unreal. But talking of concentrating wealth or concentrating where the share market is so overvalued, let's talk about the tech stocks now, because the last chart that you bring up is the tech to gold ratio. Now, I found this really interesting and I wanted to ask you about it because it's not something that you normally see. You don't normally see a sector or a group of stocks being compared to the gold price. Why is it you look at the markets through that lens, Dan?
Yeah, well, I should say I know that that's not without controversy. And there are also people who think that the market cap to GDP ratio is an antiquated and useless metric because they say, well, US companies derive their earnings from all over the world, but their market cap is just a function of US liquidity. But I think in that case, you're still looking at the ratio of financial assets to the real economy. And I thought what was interesting about the NASDAQ to gold ratio was the same. Whereas gold is a real asset, it's a monetary asset, and tech stocks are equities, but they're mostly about growth in the future. So in an interest rate world where nominal interest rates are below the target interest rate is 2%, but adjusted for inflation, real interest rates are negative. It becomes really difficult to price assets. And I would actually recommend for those readers who haven't looked at Greg's work on this. Greg taught me a lot of this when I was in Australia for 10 years, talking about the importance of the risk-free rate of return as defined by government bonds being the key rate to figure out what you should pay for all other assets. So when the risk-free rate as defined by the 10-year US government bond is effectively zero, it becomes really almost impossible to set what a fair price should be for a risk asset like an equity. And so the rational response or the kind of bubble response is, well, if the risk-free rate is zero, then I'm willing to pay almost anything for growth more than that. And so the fastest growing stuff, where revenues are growing the quickest, not necessarily earnings, but certainly revenues growing the quickest, gets the biggest premium in the share market. And I think that's what that chart shows is gold doesn't have any yield, right? This is traditionally the knock on it as a safe haven asset, is that if anything, it often costs you money to store it in a vault or with a third party, whereas at least a government bond, which is also safe, has a yield. Well, government bonds don't have a real yield right now. Gold still doesn't have a yield, but risk assets don't even try to have a yield. So people are paying tons of money for them. The best expression of that is this ratio between the NASDAQ 100, the largest tech stocks in the US market, the fastest growing stocks with the largest market caps where all of the liquidity goes into, versus gold. And what that chart shows is that gold's never been cheaper to tech stocks, or tech stocks have never been more expensive compared to gold. Now, people rubbish this kind of ratio as well because there's a famous ratio, I think, showing the price of avocados correlating with Bitcoin. And the famous dictum is that correlation is not causation. That you can put two things side by side and show their relationship to each other, but it doesn't mean that relationship necessarily tells you anything about the value of either of those things. I don't think that's the case. It might be the case with avocados and Bitcoin, but I think in this case, the value of tech stocks soaring while gold doesn't go anywhere tells you that the biggest beneficiaries in the biggest bull market of all time have been this sector of stocks. So that when there's a mean reverting correction or crash, which there always is when the liquidity disappears, that's where you have the most risk. And that's why the whole focus of the issue was how to avoid that big loss. Because when that happened in 2000, the NASDAQ, which had gone up, was like 89% in 1999, fell by over 75% the next 3 years. So our warning, Bill and I are focused on preserving your wealth if you're at or near retirement age. And the question is, can you afford a loss of more than 50% to the value of your portfolio because you have time to make it up should the market go back up? We don't think that's going to happen. We think there's definitely going to be a mean reverting crash, and we think typically it takes between 7 and 10 years just to get back to break even if you bought at the top. And we don't think that baby boomers are in a position to be able to afford that kind of drawdown. So we're just trying to bang the drum and say that's your risk if you're all in on these tech stocks right now.
I guess I'll just make one point. I guess in comparing things to the value of gold, I mean, it gives you a long-term mean, doesn't it? Because gold's been around for like thousands of years and it's been used as money for thousands of years. So that gives you an historical mean to judge these things by. And the things that you're judging by can come and go. Tech stocks this year could be house prices back in the 1920s or whatever. Do you know what I mean? Or suits. What's that famous thing? You could buy a suit in the Roman Empire. Not that they wore suits back then, but do you know what I mean? Like it's going to be, an ounce of gold will buy you a similar amount back then as it would today.
Yeah, I think that's a really important point. And it's a point that I've tried to make in the newsletters, that we don't recommend gold as a way to get rich in dollar terms. We recommend it as a way to not get poor by losing the value of your savings to inflation or putting all your money in an asset bubble. It's inherently a defensive asset about preserving the value of your savings. If you want to get rich in gold, you have to take some risk, which means you have to buy mining stocks, which means you need to pay attention to how those companies are run. And, that's a whole separate industry. So I think you make a good point that when we look at gold relative to tech stocks, what we're showing is that gold doesn't change. As a safe haven asset. It shouldn't change. It should stay basically the same. What it shows is that the risk in other assets is extremely high right now, and that's not necessarily being reflected in other prices that would normally tell you that, like junk bond yields. So you have to look a little bit further afield to say what level of systemic risk is there really in the market. So that's the reason I included that chart, is to say, doesn't mean these aren't great companies that haven't changed the world and have billions of users like Facebook and Google. It just means that their future earnings are being priced so richly right now that history tells you that can't, that doesn't last.
Finally, a big takeaway, and this is kind of your final warning in the issue, and it's kind of linked to that last statement, is that you were kind of warning or maybe imploring people actually to not sell their gold, and you drew on the big lesson from the Weimar Republic. Why did you bring the Weimar Republic into it? Like, what are the correlations between what happened back then to what's happening with the things like the dollar and stocks today?
Yeah, I think there's 2 points. And the first one, especially in last month's report, was that it happened in the context of the U.S. withdrawal from Afghanistan. And at the time, I was reading the history of German banking regulations and excuse me, and finance during the war to fund World War I for the Germans. So the Germans, the French, and the English, without getting too far into the details, all basically funded the war the same way. They borrowed from domestic savers and they borrowed from international savers when they could. But interestingly enough, during the war, Germany had pegged the value of the Reichsmark to gold at a 3-to-1 ratio. So the money was backed by gold with some leverage, but it was still fundamentally backed by gold. So Germany didn't have a hyperinflation crisis until after the war. And that was the main point that I made in the letter, is that the loss of confidence and the loss of morale that came in the currency came after the military defeat. And it also came because the German government had to pay massive reparations. And at that point, the government had to find ways to print money and escape this link to the mark. But what happened, which in retrospect looks crazy to us, is that German savers who had a lot of private gold sold that gold to the Reichsbank in order to stabilize the value of the currency and support the war effort. So they were thinking, we've got to win this war. And if when we do, we'll get a bunch of French gold and we'll get paid back. But we can't have a currency crash or an economic crisis because we didn't do the right thing, which has become a pretty popular phrase.
So many correlations when you think about it.
Yeah, I think the other point I wanted to make with it, with regards to crypto, and I was elliptical about it, I probably should have been more direct, is to say, if you're looking at a safe haven asset to hedge your risk of inflation, or because you're trying to somehow get your money out of the financial system so it's not at risk, don't equate crypto as purely a digital form of gold, which I know a lot of our colleagues do, because it's just too new of an asset class for it to be treated the same way. And more importantly, it could be trapped in that way. And I say that for two reasons. One, I know this is a theory that Jim Rickards has articulated, but I've heard other people say it, that there's a conspiracy theory that Bitcoin is actually just a giant honey trap for money launderers and terrorists and criminals, that it's been set up as a way to monitor illegal activity for people who are trying to cheat the tax system. But I think more importantly, you're seeing in the West, and by that I mean from Christine Lagarde at the European Central Bank, from Elizabeth Warren in the United States Senate, from the SEC in the United States, from people all over, who are treating not just Bitcoin, but cryptocurrencies as a threat to the legacy financial system and as an example of money laundering or criminal activity. So you just need to be aware. Yes, you can have your gold confiscated. Gold was made illegal in 1933, but this is an example that if you're trying to diversify your risk to a crash in the equity market or a currency crisis in the US dollar or somewhere else, I wouldn't put all of your eggs in one basket, and that basket includes Bitcoin, even though it's done incredibly well for a lot of people.
Fascinating. I don't really have any other questions, Dan. I just thought what you guys do at the Bonner Denning letter is you really do connect the dots, and you look at history to kind of find a bit of context and a bit of precedence to what's kind of happening today. And because a lot of people don't actually look at history, and a lot of these things that we're seeing today, like in a way, like you mentioned the reparations which happened in the Weimar Republic had to pay to the Allied powers. I wonder if there's almost a correlation there with I mean, it's not necessarily reparations, but this huge infrastructure bill that they're doing. I mean, that's gonna mean the government's gonna have to print loads more money to pay for it all. So there's not not a direct correlation, but it could cause some kind of inflationary nightmare, which means you want physical assets like gold and just companies that produce stuff.
Well, it's a great point, and I mean it's directly a great point in the sense that there's now a growing discussion in the United States about whether descendants of slaves or people of color should be paid reparations based on the economic output that was stolen from them or robbed from them during European colonialization. So there's not a bill in Congress yet, but that discussion is much more advanced now than it was then. Of course, we don't have the money for that, and there's all sorts of thorny questions about who qualifies for that. But in the context of all the discussions that are going on right now, I think people should remember two things. One, just as we've seen that the Chinese Communist Party started attacking its private sector last year with Jack Ma, then it started attacking real estate developers to rein them in so that they were focused on common prosperity and not shareholder profit. That discussion is going on in a different form in Western markets. And the target is not billionaires and trillionaires, because they're the ones who can pay for all the lobbyists. The target is people who own financial assets and have money in their bank account. That's where the money is. So when we talk about capital controls and financial repression and all the tools that the government can use to confiscate your money or tax your returns at a higher rate, or to prevent you from moving your money where you want to move it, those things are happening now explicitly, and they're happening faster than we probably expected them to happen. COVID has kind of accelerated that because it's put in charge people who who like doing this sort of stuff. So I guess that's our focus in the Bonner Denning letters, to show that a lot of these tools and technology are new, but the basic struggle of individual people trying to improve their life by either hanging on to the money they've made or passing it on to their children or even growing it by putting it at risk, that's under attack right now. And you need to be aware of that. And you need, when you look at history, you see that this isn't the first time it's happened, and it certainly won't be the last time, but it may be the only time it happens to you. And this may be the only chance that you get a chance to do something about it. So we're focused on the risk side. I know you have a lot of really talented people who are focused on the opportunity side. And I think you need to put both those pieces together if you want to come out of this, 10 years from now saying, boy, those were incredible times. I'm glad we didn't get wiped out.
And that's exactly what the Bonner Denning letter helps you do. And the good thing is we've got a great offer going on at the moment. If people haven't had a chance to read it, you can do so. And you also get Bill's latest book, which is also a fascinating read, which goes into these ideas in a lot more detail. So Dan, thanks so much for your time, mate. It's a fascinating conversation. And hopefully we can have one of these again very soon.
No problem, Woody. Thank you. Take care.
Enjoy Wyoming, mate.
I will. Thank you.